Well, as expected, the Bank of Canada held its interest rate today after increasing it back in both June and July. Now, I know that sometimes it feels like the interest rates are just not going to stop increasing. Some of us may have flashbacks too, or may have family members that lived through the 1980s and the incredibly high interest rates from that period of time. Now, while I don't expect that we're going to see interest rates anywhere near those double-digit levels that happened then, this has been a very uncomfortable set of rate increases over the last year and a half. Since the COVID-19 induced lowering of the Bank of Canada rate to 0.25%, we have now seen since March of 2022 that the bank has increased its rate by 4.75%. So the rate is now at 5 prime, the retail rate, of course, quite a bit above that. But the question is the bank done? And the truth is that remains to be seen. After the two increases in both June and July this year, there has been a lot of information and data that's been released that has really contributed to today's announcement and might be enough that we won't see any more increases this period or this cycle. GDP growth, for example, for the second quarter of the year was disappointing. Economic growth in Canada has dropped to nearly 1%, and it might be slipping further. The bank tells us that this is needed in order to relieve the price pressures, but it doesn't feel good to the average Canadian to be going into recession. Employment rate is now trending downward and is back below pre-COVID levels. It was sort of increasing over the decade leading up to COVID, and in about 2018-19 had surpassed that 62% rate, and we're now back down to about that, or even just a bit below it. Inflation, it's been trending downward in Canada as well, and of course in the advanced economies around the world. But it shows signs of being sticky at about 3%. We had a month below 3, and then it bounced back up to above 3 right before we saw the rate increases over the summer. And that has the bank quite concerned. The drop from over 6% down to the 3% mark, that happened fairly quickly, but the path from 3% down to 2% might take a lot longer. Regarding the 3% inflation, the bank tells us that the longer high inflation persists, the greater the risk that elevated inflation becomes entrenched, making it more difficult to restore price stability. What that means is then we start having wage increases going along with it, which of course we want to have the wage increases, but if it's expected for inflation to be high, wages are increasing, making inflation high. So it becomes a self-fulfilling prophecy. David Eby, he's the Premier of BC. Last week, he wrote a letter to the Bank of Canada Governor Tiff Macklem, urging him to consider the human impact of these rate increases and to really hold off on any more because they hurt. Before today's announcement, Randall Bartlett, he's Senior Director of Canadian Economics at Desjardins Group, and he said that the recent GDP data reinforces their view that the bank is done hiking rates for this cycle and that its next move is going to likely be a cut, possibly as early as the first quarter of 2024. BMO's chief economist Douglas Porter wrote a few days ago that the case for the bank to pause is now overwhelming. So they did. And while they're not ready to definitively rule out more hikes because of a few mild complications, he wrote, but further he wrote that the likelihood that growth is going to continue to weaken in the second half of the year, that's the GDP data that I mentioned earlier, that should eventually clear out these temporary complications. So, in conclusion, while the bank is pausing right now to allow more time for more data to come in and for the lagging effect of the more recent rate increases to really work their way through the economy, the bank is still concerned about sticky inflation. So the concern of further increases, it is lessening, so that's good. And hopefully we are going to start seeing some rate reductions early in the new year. Now, if you are directly impacted by this, if you're wanting to get into the market, if you have a mortgage that's coming up for renewal and you're concerned about these new higher rates, please reach out to me and my team. We are definitely looking forward and able to assist you to help you navigate these complicated times. But the good takeaway here is that we're probably close to the end, if not already at the high point of the interest rates. Thanks so much, and look forward to chatting with you soon. Bye-bye.